Ooh, and they debriefed me. I don't dare moving. No, it's a very timely conference. I mean, you're aware that the European Commission has dedicated quite a lot of energy to try to move forward the issue of sustainable finance in all its various dimensions. Because if you don't have a holistic approach in that respect, probably you don't achieve your target. I mean, you cannot move in isolation on one front. Well, you can, but that's very suboptimal. And that's the reason why in the Capital Market Union Action Plan, we have identified this as one of the key elements in the version 2, the relaunch or in the launch of the second phase of Capital Market Union. And this is what has triggered last December the launch of the high-level expert group on sustainable finance, chaired by my friend Christian Timman. And I have to say they have been doing a very excellent work. We're expecting their final report in the very beginning of next year. And it's not completely decided yet, but what I would like is that there is a quite bold follow-up to the recommendations of the group through a roadmap or an action plan and an immediate deliverables on some of the early recommendations they made in the interim report in July. So a very intensive work ahead of us. We are committed to promote a number of measures, and of course at the forefront, better integrate sustainability, ESG in rating methodologies, supervisory processes as well, and also in investment mandates of institutional investors and asset managers. We're also committed to develop an approach for taking sustainability considerations into account in upcoming legislative reviews of financial legislation, so the so-called sustainability test that the HLG proposed in its interim report in recommendation number 5. We think it's very important. Let's see what the rest of my colleagues in the Commission will think of it, but we're certainly very committed to push this forward. So these last 3 months have been extremely rich in the field of sustainable finance. I mean, publication of the guidelines on non-financial reporting, the launch of the HLEG interim report, I just alluded to it, public hearing on sustainable finance, the CMU midterm reviews, and President Juncker State of the Union speech that also referred to it. But more specifically, last week we have adopted what we call the ESA review. I know you have talked about it this morning, and we were, my colleagues and I, pushing a lot to have some new objectives in the mandate of the ESAs, so that they have a legitimacy in this field, and I'll come back to this in a minute. But also we have launched work streams on a number of specific topics, some of them very important. I know you have discussed about fiduciary duty. This is something we think is very, very challenging and complicated to put in place, but also very important. So we have already launched a work stream on this. Green classification of assets is also something that is important to us. When you cannot possibly develop standards on sustainable finance if you first do not have a taxonomy that works, that is widely accepted. All this is extremely important, but also extremely challenging. Among the new priorities set by the Commission in the Capital Market Union midterm review in June, strengthening the EU's leadership on sustainable investment is one of the most important ones in my view. We think that now that we have put at least the peak of the crisis behind us, it's really time that we look forward to the future and including the long-term future, and tackle also in the world of finance some of the very, very big challenges ahead of us long-term associated to climate and environmental issues in particular. So I have to say Vice President Dombrovskis, my boss, is fully behind this agenda. He's made clear in Tallinn recently in Eurofi in a speech. And he is deeply convinced, as I am, that what we need is really a deep re-engineering of the financial system for investment to become more sustainable and for the system to promote truly sustainable development from an economic, social, and environmental perspective. So that means we need to find innovative ways and solutions, first of all, to integrate sustainability into our own EU regulatory framework and financial policy framework as well, and to mobilize and orient more private capital flows towards sustainable development. So these are the two big objectives. One depends only on us in a way, but not everybody's as green as I am in the Commission. I have a couple of friends in DG Environment, DG Klima, and a couple of others that are, say, less sensitive. So we need to make a bit of advocacy in order to promote it as a tool for the Commission as a whole. But we can count for this on the backing of President Juncker, and that's extremely important. And we're not starting from scratch either. I mean, we have already taken a series of regulatory initiatives from ESG, environmental, social, and governance, disclosure requirements, also in accounting with accounting and non-financial reporting directives. So in a number of standards and texts of the EU, including in disclosures and reporting, you have already today a number of obligations that did not exist 3-5 years ago, but we know we definitely need to go forward. We have also a number of requirements where these factors should be considered for the investment approach in PRIPS, for example, but also more recently in the risk management of investors. That was, in my view, one of the key innovations in the IOP2 directive. And I think we should try to export it onto other sectors than pension funds, in particular insurance and in particular life insurance. And of course, not forgetting to mention the design of appropriate regulatory frameworks to support cross-border capital raising and investment, the European Venture Capital Funds, UVK, Social Entrepreneurship Fund, USEF, and the Long-Term Investment Fund, LTIFs, that all can be put at the service of financing socially and environmentally responsible projects. So we're not searching for scratch. There is a strong momentum already, but we need to move forward. And moving forward, in my view, means finding effective and innovative ways to hardwire sustainability in our future, but also in our existing financial regulatory framework. And this is what we will do, I hope, on the basis of the report of the high-level group as of this spring. So that's really the next step forward. I mentioned it already, but the first stone in this new movement, if you wish, it was last week with the ESA package. Because with the ESA package, for the very first time, we specifically required the supervisory authorities in Europe to take into account environmental, social, and governance factors in their supervisory duties. That is completely new. They had no mandate so far to take this into account. Of course, the mandate without the text is not much, but I would say that's the seed capital to start developing in the spring on the basis of the report of the high-level group, the rest of it. We needed to have it in the mandates so that whatever obligations we put in the future text or we insert into existing regulatory legislations in Europe, the ESAs have the effective possibility to follow up and monitor and take action if needed. So I'm convinced that this new framework will help mobilize and orient private capital towards sustainable investment by factoring ESG considerations in the duties and obligations of institutional investors in particular. And I think that is extremely important because the ESG preferences and needs of beneficiaries are in reality very, very occasionally taken into account for the time being. While investing, institutional investors, fund managers generally understand their duty to clients as requiring an exclusive focus on the maximization of short-term return, which is fine. I mean, they should do that as well. But rather not on ESG, on longer-term sustainability requirements. And this leads, in our view, to a capital allocation that may increase market failures and undermine the society collective interest and the trust in financial markets. I know this morning you discussed the issue as how it should be treated, brown and green investment. And I understand that there were various views that were brought forward. I'll offer my personal view. I've always been reluctant to promote a green supportive factor. And the reason why I'm reluctant to do this is that I think that the main purpose of financial regulation and prudential regulation is to give a risk signal to investors. And something can be very sustainable, very desirable, and yet risky. And it should be therefore dealt with as something risky, not as something less artificially made less risky in order to promote it. But conversely, I think broad investment bring about a number of risks to society in the form of negative externalities. And I've always been convinced that the main purpose of regulation is actually to transform negative externalities that are long-term and cannot be appropriated by financial or by any economic actor, into an individual cost that individual market players can appropriate and that can take into account in their profit maximizing strategy so that they behave in a way that is long-term socially desirable. If you take it from that point of view, then you have every reason to have higher capital charges for brown investment because they create a cost for society long-term. And the fact that this is not translated absent a regulatory mechanism into an individual cost for market actors doesn't do away with the fact that this cost exists. So I think our duty is to make this cost apparent so that the market can take it into account in designing its strategies. So I'm sort of half in agreement. I mean, yes, we should penalize brown investment for the reason I just said, but no, we shouldn't favor otherwise green investment because we should treat green investment according to its risks. But of course, if you penalize the others, then you have a differential that makes green investment more attractive per se as well. And there are a number of other trade-offs. I mean, we need to have these discussions and we need to discuss it, and we need then to expose policymakers in international standard setters. I was discussing it just before taking the floor. It is still not mainstream in international standard setters to think along these ways. The Basel Committee, the IFRS Co-Foundation, name it. There are very few people and individuals that are sensitive to these issues and have developed a reflection on these issues. We're very fortunate that Mark Carney is one of them. So as is the lead in the FSB, he steered, and I tried to help him as much as I could, steering works towards that end. But let's not be mistaken. In this fora, these works rely on few individuals And if these individuals disappear tomorrow, then the work will stop. It's not mainstream yet. And there is a lot of work to make it mainstream. And that's the reason why we have launched the high-level group. We want to mainstream this flow. So what's next? What could be the further steps to be taken to develop in the EU a comprehensive and coherent sustainable finance strategy? Well, we have some ideas, but it's fair to say that we are currently exploring with our friends in the high-level group. And as you probably know, we will fully develop our view in a communication on sustainable finance that we will publish shortly after the final report of the high-level group. I can tell you what we are thinking, or which are the topics we are exploring, maybe. And they will not be surprised because it's very much based on the works already done by the high-level group. The first thing is the need for an EU classification for sustainable assets. Because if you don't have this, there's hardly anything else you can produce. I mean, how can you give a specific treatment to brown investment if you don't know what's brown? And if you don't know that's green, or if you have a discussion about it, or if what is green in one jurisdiction is not green in the other. So we want to lead on that work, but it will be fully effective only if we're able to have something that is really, the theoretical foundations of which are really solid and that we are able to export to the rest of the world. Because in this area, like in many, we can go forward. We can go forward before the others, but it would be suboptimal if we do not manage to have a level playing field. So that's very important. And this classification, it's in this respect extremely important for me. Secondly, we need to have a coherent disclosure and reporting framework. A framework that encompasses all key actors in the investment chain. And that would be the bedrock for the EU sustainable finance policy. So taxonomy and disclosure reporting framework are the two pillars on which we could build something. And then we can build a number of things. We could develop EU green labels for investment funds in order to avoid market fragmentations, such as having the current competing labels in Europe, and help raise green awareness among retail investors. We could clarify that managing ESG risks is integral to fulfilling fiduciary duties. I understand you have discussed it as well this morning. And taking an initiative, a legislative initiative in the field of fiduciary duty is something we are exploring with our colleagues in DG Just. But that is also something that is complex, very complex. The technical difficulties of which shouldn't be underestimated. And don't be mistaken, in all these fields, I mean, we have more enemies than friends. So we need to be, I mean, our proposals need to be perfectly calibrated. Because if they're ill-advised, if they are very well intended but not very well researched, there will be a number of people to shoot them down. So we want to carry it very thoroughly, very intensively, as we have been doing so far with the high-level group. Going forward, and it's not the least challenging project, we think it would be interesting to foster the integration of sustainability and long-term perspectives into credit rating. Easy to say, complicated to put into effect, but we have started already to think about it. And finally, when I say finally, it's provisional end. We could also think about how to improve the current methodology for conducting impact assessments in order to properly integrate sustainability into the relevant EU financial legislation. So the sustainability test I referred to at the beginning of these remarks. So And many other things. There are other projects that are more challenging. I did not mention on purpose the old prudential regime discussion, the old accounting standard discussion, which are also very important, but even more challenging, because there is a lot of advocacy to be done in this field. I can tell you that the main actors are far from being convinced that their current framework that is focused on short-term returns is not the right one. So we need to continue our work to explain and convince in international fora, because we need to obtain some form of consensus. The last thing I'd like to say is that it seems for the time being we will certainly not obtain consensus from a big jurisdiction that sits on the other side of the Atlantic. It's a problem, and it's also an opportunity. I think that the fact that the United States are disengaging is a disaster in a way. But for a financial community, they should see it as an opportunity and a reason, an additional reason to commit and forcefully engage into these projects, because I'm certain that the part of the world that will have taken a competitive edge in this domain will keep it for quite a long time. And as this sector will grow in importance over the years, I think there is really a business opportunity there. And so if they're not convinced that it's good for environment, we should try to convince that it's good for their finances and try to attract more support from that angle as well. So that's it. We've been doing a lot, but there is a lot more to do ahead of us. We're carrying this work in DG FISMA in complete association with the friends in the other DGs, Environment, Clima, but also interestingly DG Enterprise, because Mrs. Evans, the Director General of DG Enterprise, sees it also as an opportunity and not as a threat for the EU businesses. So that's it. If you wish to put one or two questions, I'll be happy to, but I have a meeting with one of you that should have started 7 minutes ago, so we're a bit short of time.
Maybe let's take just one burning question over there, and that's it.
We are Canadian-Belgian company, kind of an SFTD, dealing with investment professionals. 21st of September, as you know, CETA was brought into force. I believe now my colleagues interview Canadian ambassador regarding this. I have a very important question for you. In Canada, we are dealing a lot with sustainability. And tell me, please, do you foresee any stimulus for Canadian investment companies to invest, and do you need it at all, to invest in Europe and vice versa? Because in Canada, we have lots of very interesting achievements in sustainability, but the same weight approach as you just demonstrated to us. So what is your attitude to Canadian investments here, and are there any incentives for them? Thank you.
Thank you. I read over the weekend that French study that CETA is extremely bad for environment because they calculated the number of miles that a kilo of meat will travel and all this, but that's not your question. CETA is the trade agreement in which the financial sector chapter is the most developed so far, in particular in the area of funds. So to answer your question, there are more incentives now that CETA is in force for Canadian funds to invest in Europe because there are less barriers as a result of CETA having taken effect. So the answer is yes, for that reason. It's not true in all fields of financial services, but in the field of fund management, it is certainly true.
Okay, I'm afraid that's all we have time for today. Thank you all very much for coming.